US dollar to Japanese yen has surged to 157.90, sitting on the precipice of the 158 level, which many Tokyo desks now view as the immediate red line for the Ministry of Finance. This move follows hot US inflation data and hawkish Fed signals, leaving the yen vulnerable. Today, we break down why the 158 threshold matters, the surprise hawkish signals from the Bank of Japan, and how Nikkei futures are decoupled. Heading into this session, the market was operating under the shadow of Japan's record $65 billion intervention campaign. Following that massive liquidity injection, US dollar to Japanese yen had established a tentative floor between 150 and 155. However, the underlying yield differential remains the dominant force. One macro analyst notes that the previous intervention effectively recalibrated the yen from undervalued to fair in the eyes of the authorities, but the relentless strength of the US dollar, fueled by higher for longer Fed expectations, has pushed the pair back into the danger zone. Positioning had been leaning toward a period of consolidation, but the breach of 157.50 yesterday triggered a fresh round of momentum buying, putting the Ministry of Finance back on high alert as we approach the psychological 158 barrier. The primary catalyst for this leg higher was a combination of hot U.S. producer price index data and a series of hawkish confirmations from Federal Reserve officials. Geopolitical tension also played a role, with a ship seizure adding a layer of risk premium that perversely strengthened the dollar as the ultimate safe haven. However, the most significant intraday volatility came from within Japan. Bank of Japan policymaker Masu stated that an early rate hike is desirable provided there are no major economic downside risks. This hawkish tilt suggests the central bank is increasingly worried that yen weakness will de-anchor inflation expectations. We saw a sudden 40-pip drop in US dollar to Japanese yen following these comments, briefly mistaken by some traders for intervention, but it was ultimately a reaction to the BOJ's shifting tone. Meanwhile, JGB 10-year yields have climbed to 4.095%, moving in lockstep with treasuries. Views from the ground in Tokyo are shifting rapidly. A macro FX trader, Barry van der Laan, points out that US dollar to Japanese yen at 157.90 is a direct test of the Ministry of Finance's resolve, noting that the June 19 Bank of Japan meeting is now the critical catalyst. Local Japanese FX specialists are highlighting the Masu bounce, where intraday yen buying spiked on the suggestion that the BOJ won't wait for the currency to stabilize before acting on rates. Financial headline desks are also tracking Standard Chartered's view that the government has effectively drawn a line in the sand between 150 and 160. The consensus among Tokyo analysts is that while the 158 level is a technical trigger for jawboning, the real pain point that forces a $65 billion style intervention remains closer to 160. How does this propagate through your portfolio? First, the FX pressure is a double-edged sword for the Nikkei. While a weak yen typically boosts exporters, the volatility at these levels creates uncertainty. However, JGB yields hitting 4.095% are putting significant duration pressure on Japanese bonds, which is a signal of a deepening carry trade unwind risk. For Nikkei traders, the focus is on the semiconductors and tech sectors, which are currently decoupling from the yen's weakness and following the US tech rally instead. The transmission channel here is clear. If the Ministry of Finance intervenes at 158, expect a sharp, temporary spike in yen strength that could hammer the Nikkei 225 futures in the short term, even as JGB yields remain elevated due to the BOJ's tightening bias. The Japanese financial press, led by the Nikkei and Reuters Tokyo, is focusing heavily on the domestic political cost of this yen weakness. There is an increasing narrative that the Ministry of Finance and the Bank of Japan are coordinating more closely than in previous cycles. Reporters are highlighting that the cost of living crisis in Japan is putting pressure on the Kishida administration to ensure the yen doesn't slide past 160 again. Unlike Western desks that may focus purely on yield differentials, Local outlets are emphasizing the BOJ's June 19 meeting as a live event where a policy shift or a specific reduction in JGB purchases could be used as a tool to support the currency, alongside direct market intervention. Positioning data suggests that leveraged accounts are still heavily short the yen, but we are seeing a significant amount of profit-taking as we approach 158. Real money accounts and the Government Pension Investment Fund, or GPIF, are being watched for any shifts in their foreign asset hedging ratios. Retail margin traders in Japan, often a contrarian indicator, have started adding to yen longs, betting on a government intervention. Standard Chartered's analysis suggests that the $65 billion spent so far has effectively created a valuation ceiling. If 158 breaks without an immediate response from the Ministry of Finance, we could see a vacuum move toward 160 as shorts cover and momentum players chase the breakout, further stressing the domestic market's stability. The immediate watch list starts with the 158 level in US dollar to Japanese yen and the 160 psychological cap. Watch for rate check rumors from the BOJ, which usually precede physical intervention. On the data front, keep a close eye on any further comments from Governor Kazuo Ueda or other board members ahead of the June 19 policy meeting. In the equity space, watch the 63,100 level on Nikkei futures. The night session's 380-point climb shows resilience despite the FX volatility. Finally, monitor the 10-year JGB yield. If it sustains a move above 4.1%, it could signal that the market is pricing in a more aggressive hike cycle than the BOJ has officially communicated, potentially leading to a sharp repricing of yen crosses. In our baseline scenario, the Ministry of Finance uses heavy verbal jawboning at 158, successfully slowing the yen's descent until the June 19 BOJ meeting, where a hawkish hold stabilizes the pair near 155. This would be neutral for the Nikkei. The hawkish scenario involves a break past 158, triggering an immediate multi-billion-dollar intervention and a surprise rate hike signal from the BOJ. This would likely cause a 3 to 5% correction in the Nikkei but a massive 300 to 500 pip rally in the yen. In the dovish scenario, the BOJ remains cautious on June 19, and the MOF fails to intervene at 158. This would likely see US dollar to Japanese yen blast through 160, causing localized panic in Japanese import-dependent sectors but potentially providing a short-term sugar high for major exporters. To wrap up, US dollar to Japanese yen is testing the 158 intervention threshold, BOJ policymakers are sounding increasingly hawkish, and Nikkei futures are holding their ground despite the currency stress. Keep 158 and 160 on your screens, and watch the June 19 meeting as the ultimate arbiter of this trend. For more daily briefs on the macro forces moving Japanese markets, subscribe to Tokyo Macro. See you on the desk tomorrow.